Welcome to StickMan Explains.
Imagine, in just a few centuries, humanity went from trading sacks of wheat in dusty bazaars to a world where anyone can buy a share of Tesla, a barrel of Brent crude oil, or the currency of a country they've never visited, right from their smartphone. This is the stock exchange, or the broader concept of the stock market. To many, it looks like an endless stream of numbers, charts, confusing jargon, and panicked headlines. But in reality, it's a grand mechanism that has changed everything. It was largely thanks to exchanges that we got railroads, automobiles, factories, and modern IT giants. For centuries, millions of people helped raise money for massive projects that no single merchant could have bankrolled on their own. But, like with everything around us, there's a flip side. The exchange has always been an arena of greed and fear, of mathematical calculations and intuition, of luck and risk. So why did people invent such a strange and dangerous tool in the first place? And how did simple grain deals in medieval Europe evolve into a global network where all the world's money is churning today? Let's start from the very beginning. We'll explore when and why exchanges first appeared, and how they gradually transformed our world into what we see today. Buckle up, we're getting started. Let's travel back to Europe, say, somewhere around the 13th century. Picture a small European city in northern Europe. Narrow streets, horse-drawn carts, and bustling markets. Merchants from different countries come here to sell cloth, spices, and wine. Someone might be hauling goods from Sicily, another from distant Arab lands. But there's a problem. You've transported your cargo for months along roads plagued by bandits or sailed your ship through storms, only to arrive and face unpredictable prices. Today, a sack of grain costs one price, tomorrow, it could be half that. Or the other way around. One very rainy season, and the harvest rots. The remaining grain is sold at sky-high prices. People were afraid to take risks. There were too many unknowns. And without risk, there's no trade. Without trade, there's no economy and no progress. So, the shrewdest merchants began to meet in advance and arrange deals for the future. Essentially, they were making simple contracts. In 6 months, I'll bring you 100 sacks of wheat, and you'll pay me this much. This is how the earliest precursors to futures contracts were born. People began to hedge their risks and lock in prices. This allowed them to calmly calculate their profits and invest in caravans, ships, and farms. They also needed a reliable marketplace where all these deals could be executed. A place where everyone would know the price of grain, wine, or wool. This led to the creation of the first trading houses. And that brings us to Bruges. The 14th century. The heart of northern European trade. Here, on one of the main squares, stood the home of the Van der Beurs family, wealthy merchants and bankers. Their family crest was adorned with 3 symbolic purses. And where else could an exchange be born, if not here? The Van der Beurs house became the place where merchants from all over Europe came to discuss and close deals. They came here to get the latest news, sign contracts, and exchange promissory notes. Gradually, this place became more than just a hospitable home. A whole square formed around it, crowded with traders, brokers, and money changers. And the word for exchange, bourse, in many languages, came from here, from the Van der Beurs family name. A little later, the Belgian port city of Antwerp picked up the baton. In the 16th century, it was arguably the busiest port in Europe. They traded in spices from Asia, silver from the Americas, and wool from England. And it was here that the world's first building officially designated for trading operations was constructed. It had high arches, a roof to keep out the rain, and even rules of conduct inside. You could say it was the first proper trading floor. And you know what's interesting? Back then, they were still trading in real goods, grain, fabrics, metal. But alongside commodities, they also started trading currencies. Even in the Middle Ages, merchants had to transport goods through different principalities and cities, each with its own coins. By the 16th and 17th centuries, this had become a real business. Money changers and currency deals emerged. You could say these were the world's first forex operations, only they happened in person, not through a computer like today. And very soon, stock trading would appear, where you could make a fortune or lose everything without ever holding a single ounce of a real commodity. For that, we need to head to 17th century Holland. There, they invented something that would change the world: joint stock companies. The 17th century. Amsterdam, then the richest city on the planet. Its port was filled with hundreds of ships delivering spices, tea, tobacco, and silver from all corners of the globe. At the time, silver was the primary metal for trade. Gold was used more for reserves and very large international transactions. So, silver was essentially the dollar of its day. By the way, check out our videos on the history of the dollar and why it's still the world's main currency. Back to Amsterdam. A single company emerged here that changed the course of history: the Dutch East India Company, or VOC. It was the world's first publicly traded company, where any prosperous citizen could buy a tiny piece of a massive expedition. You know why this was genius? You weren't buying a ship, you weren't hiring sailors, you were just buying a piece of paper, a stock, that gave you the right to a share of the profits from the spice trade. For the first time, ordinary citizens, not just dukes and barons, could become investors in a huge corporation. In the modern world, this is called an IPO, or initial public offering, when a company sells shares to the public. The company gets funds to grow, and the investor gets a chance to receive dividends from profits, or to speculate, hoping to sell the shares later at a higher price. This was the birth of the first true stock market. The term stock market comes from stock, representing a share of ownership. On the Amsterdam Exchange, securities were traded not just for cash, but also through forward contracts, which led to the formation of a speculative market. It was here that the first bulls and bears appeared, speculators who bought stocks not for dividends, but to profit from price swings. By the way, the bull and bear metaphor originated in England. A bull thrusts its horns upward, signifying a bet on a price increase, while a bear swipes its paws downward, signifying a bet on a price decrease. The first brokers literally manipulated the market, spreading rumors about caravans that had supposedly sunk to crash prices, then scooping up the cheap shares. The city was buzzing. Some people became fabulously wealthy, while others lost everything. And for the first time in history, among the general public, trading became more than just a simple transaction. It became a game of faith, expectations, and understanding market sentiment. And this excitement led to the first speculative mania in history, one that's still written about in investment and trading textbooks today. Let's jump forward a few decades in Holland, to the time of tulip mania. In the 1630s, Holland was the wealthiest country in Europe. Ships brought in spices, gold, and carpets, and the streets were filled with merchants and bankers. And suddenly, into this bustling trade, burst the tulip. Yes, a simple flower. Well, almost simple. Some rare varieties were so beautiful and unusual that they became a true status symbol. This phenomenon became known as tulip fever. Merchants began competing over who had the most impressive tulips. Then the speculators arrived, and things spun out of control. People started buying futures contracts on tulip bulbs. A flower that hadn't even grown yet was being sold for a price comparable to a house in Amsterdam. A single rare bulb could fetch several thousand guilders. To put that in perspective, an average craftsman earned up to 300 guilders a year. People sold their property and took out loans to avoid missing out. The newspapers, riding the wave of hype, wrote only about rising prices, while neighbors bragged to each other about their latest bulb purchase. But in February 1637, at one of the auctions, no one raised their hand. The price plummeted into an abyss. In a matter of weeks, thousands of Dutch people were ruined. Thus ended the first financial mania in history. the first bubble to burst with a deafening pop. Since then, exchanges and bubbles have gone hand in hand. But few learn the lessons of tulip fever. Because very soon, an even more spectacular scam would unfold in London. And this time, the stakes weren't flowers, but entire maritime companies. Let's go to London. The 18th century. Tea and sugar were just becoming fashionable among English ladies and gentlemen. But what was truly popular were coffee houses. It was here, over a cup of the bitter drink, that news, rumors, and deals were born. These coffee houses became the center of exchange life, where it was decided which stocks to buy and which to dump. At the time, England was desperately trying to catch up with Holland in overseas trade. To do this, they created dozens of companies with rights to trade across the ocean. The most famous of these was founded in 1711, the South Sea Company. In essence, it was a semi-governmental scam. The company promised fabulous profits from trade in Latin America. There was just one small detail: England didn't control those lands. Spain did. But who cared about such trifles when the stock price was skyrocketing? Lords, dukes, and even members of the royal family bought up shares, hoping to double or triple their capital. At one point, the South Sea Company's stock grew tenfold in just a few months. A fun fact: the renowned physicist Isaac Newton owned a huge stake in the company. He famously said, "I can calculate the motion of heavenly bodies, but not the madness of the people." London was gripped by a full-blown stock frenzy. People sold their homes and took out loans, mortgaging everything they owned. But like all bubbles, this one burst suddenly. When it became clear that there were no mountains of gold in South America, the prices collapsed. Thousands of aristocrats and merchants were left with nothing. Hundreds of families went bankrupt, and some even took their own lives. In time, England did learn from this crash. It tightened its control over the exchanges and, by the 19th century, had become the world's financial capital. By the way, it was in London that one of the most controversial practices on the exchange appeared: short selling. Clever gentlemen would sell stocks they didn't physically own. They would essentially borrow them from other owners, sell them at the current price, and then hope to buy them back cheaper to return the loan and pocket the difference. It seemed almost immoral to profit from a company's collapse. Even back then, newspapers wrote that short selling was a dirty game played against a healthy economy. Nevertheless, the stock market continued to evolve, and with each decade, more complex trading instruments appeared. Entire financial organizations and a host of new professions emerged: brokers, analysts, investment fund managers. And now, we move to the heart of the future global financial system. Across the ocean. New York, late 18th century. A young city, a former British colony, smelling of ship tar and with streets dusty from wagons. The year is 1792. Under a sprawling sycamore tree on Wall Street, a few dozen brokers and merchants gather. Here, they sign a document that went down in history as the Buttonwood Agreement. The document is now part of the New York Stock Exchange's archival collection. Essentially, they just agreed not to cheat each other, to trade stocks among themselves, and to charge a standard commission of no less than 0.25%. No one at the time could have imagined that this simple agreement under a tree would grow into the planet's leading stock exchange. At first, trading happened right on the street. Brokers shouted prices, argued, and gestured, almost like at a bazaar. But within a few years, they rented their first space, and the New York Stock Exchange was born. By the mid-19th century, New York had surpassed London in the trading volume of American railroad stocks. And by the early 20th century, hundreds of millions of dollars were circulating here. In 1901, one of the most influential bankers of the era, J.P. Morgan, founded the world's first corporation with a capitalization of over $1 billion. U.S. Steel became the largest industrial company of its time and a symbol of American industrial might. It was here that famous stock market indexes like the Dow Jones were born, which showed the mood of the entire market, not just individual stocks. They became as vital an indicator as a patient's temperature. And what happened next? The stock market became a symbol of the American dream, a place where you could become a millionaire or lose everything in an instant. And one day, that dream was destined to turn into a real catastrophe, plunging the entire world into a depression. America in the 1920s. It was the age of jazz, lavish parties, incredible technology, and an unprecedented economic boom. Electricity in every home, cars on the streets, movies starring Charlie Chaplin. Millions of Americans were actively trading on the stock market, buying shares in everything: railroads, chemical companies, tobacco factories. But most dangerously, many people were buying stocks with borrowed money, believing in endless growth and losing all caution. They would pay only a fraction of the cost and borrow the rest from their brokers, betting on the price to rise. Today, this is called leverage, or buying on margin. And then came October 1929. What President Hoover would later call an orgy of mad speculation began. Someone quietly started selling their shares. Then more, and more. Panic set in. In a matter of days, the stock market crashed. Stocks lost half their value. It was the first domino to fall. People who had considered themselves rich just days before lost everything. Banks failed one after another, taking the savings of millions with them. American industry ground to a halt. 1 in 4 Americans was out of work. Families lost their homes and moved into shantytowns. It was the lesson of the century. It was then that the U.S. first understood that self-regulating markets were a very unreliable design. They began creating real laws to regulate the exchange. They forced companies to disclose truthful information about themselves before selling stocks or bonds to the public. They banned a number of dirty practices: insider trading, where top executives leak information to friends before earnings reports; pump and dump schemes, where prices are artificially inflated and then sold off. They introduced margin requirements to prevent people from borrowing too much to buy stocks. They separated investment and commercial banks, so that ordinary people's deposits wouldn't be exposed to speculative risks. And, most importantly, they created the Securities and Exchange Commission, the SEC, which still oversees all U.S. markets today. The SEC was given the power to license brokers and exchanges, monitor for manipulation, and demand company reports. For example, in 2018, the SEC fined Tesla $40 million over Elon Musk's tweets, ruling that he was misleading investors, and temporarily removed him as chairman of the board. All these measures made the market much more transparent and safer for ordinary investors, laying the foundation for the modern, civilized stock exchange. But, as history has shown, the lust for easy money doesn't die easily. And we keep stepping on the same rake, time and time again. After the Great Depression, the exchanges quieted down, but not for long. By the mid-20th century, the markets were booming again. American companies were conquering the world, and stocks were considered safer than gold. The exchange was no longer just a place where you could buy a piece of a factory. It had transformed into an entire industry employing millions of people, from analysts and traders to fund managers and risk managers. Hedge funds appeared, which didn't just buy and hold, but used many high-risk instruments and built complex mathematical models to extract maximum profit. And then came the computers. Trading moved from noisy floors to quiet server rooms. Now, most deals aren't made by brokers in ties, but by algorithms that buy and sell in milliseconds. Welcome to the world of high-frequency trading, where billions of dollars move faster than you can blink. There's a fun movie on this topic called The Hummingbird Project, where young entrepreneurs lay a high-speed internet cable across half the country just to get stock quotes fractions of a second faster than everyone else. But the 20th century showed that there's still plenty of room for madness and human weakness in this game. Remember the dot-com bubble in 2000, when the stocks of some new companies soared by thousands of % just because they had a domain name on the internet, only to crash to zero? And the most interesting part is, even if you've never bought a single stock, the stock market still affects your life. You might be thinking, sure, exchanges are for some bankers and crazy traders who stare at charts all day. But here's the truth. The stock market affects every single one of us. Large companies raise money on the exchange to grow, build factories, and create new jobs. The more accessible capital is through stocks, the more projects get launched, the economy grows, and that means there are jobs and wages. Even mortgage and loan rates depend, in part, on how the markets are feeling. If the stock market falls, banks become more cautious, and loans can get more expensive. To put it simply, the stock market is a sort of barometer for the economy. When investors flee the market, it means something is wrong in business, technology, or politics. It's the massive nervous system of the economy, reacting to everything: wars, elections, oil prices, and even Elon Musk's tweets. And that's how exchanges have traveled from the noisy squares of Bruges and Amsterdam to your smartphone, where in a couple of seconds you can buy shares of Apple, purchase Bitcoin, or short a dollar futures contract while sitting on your couch at home. But you know what's most amazing? A lot has changed in these 500 years, but one thing hasn't: people. And despite the era of high technology, complex trading algorithms, and access to any information, it's often emotions that move prices in the stock market, not logic and calculation. Because we are still the same: greedy when the market is rising, fearful when it's falling, quick to believe in rumors and tales of quick riches, and very quick to forget history. Statistically, about 80 to 90% of retail traders lose money in the market over the long term. Thousands of books have been written about the exchange and the stock market. I've read many of them and listened to many experts. Another truth that I really like is this: the modern exchange is still just a market. And the market is always right. After all, the price of an asset is the equilibrium price where the number of willing buyers matches the number of willing sellers. And if someone is buying, it means someone else is selling at that very moment. Remember that next time there's another euphoria around some new bubble. And if you trade or invest, don't celebrate your victories too much. Because if someone made a lot of money, it means someone else lost a lot. Thanks for joining me on this journey through time, money, and human nature. Let me know in the comments which part resonated with you the most. And I'll see you in the next story.